Hello, everyone. Welcome to another episode of Firm Returns Weekly. It's been a pretty eventful week this week. We had the interim results from tinyBuild, got updates on Warner Bros. Discovery, Aviva, Taylor Maritime. So let's get straight into it. I'll just share my screen. Well, the top. Okay, so starting with Aviva, we heard this week that Aviva is going to be acquiring AIG's UK protection business for a total consideration of £460 million. And this is in line with their strategy of pursuing capital light growth. So, yeah, this brings in an additional 1.3 million individual protection customers and 1.4 million group protection customers, using AIG UK's numbers from the end of last year. Excuse me, I'm just coming off the tail end of a cold, so there might be a little bit of coughing. Yeah, this looks quite positive. I think they're looking at they're forecasting a double-digit IRR from it, and it just sort of expands there. I think this would individual protections. This would probably come under their UK general insurance segment. So yeah, that's really what they're trying to grow, rather than the things like the life insurance side of things, which requires a lot more capital to be locked up, like annuities and things like that. All that kind of stuff requires a lot more capital to be invested, whereas if you're just doing on a general insurance stuff, has a smaller capital requirement, because it's just rotated year after year, and so should help to boost the ROI for the overall business as we make a shift towards the capital light stuff. Right, yeah. So we then had a couple of updates from Warner Bros. Discovery. One was the Mortal Kombat 1, so that came out the prior week, but we now have the data for that first week in terms of how well it did in this, just the UK, but how well it did in the physical sales. So it came in at number 1, which is great. So it was the highest selling physical game. So physical, like Xbox, PlayStation, Switch copies. And what was quite cool to see was that Hogwarts Legacy, which has been dominating for most of the year, I think, held the second spot. So we actually had like a 1-2 from Warner Bros. Discovery Games in terms of the best-selling physical games in the UK, which is just cool to see. So the other piece of good news, I suppose, from Warner Bros. Discovery was the end of the writers' strike. So there's been a tentative deal struck with the WGA, Writers Guild of America, which has meant that the strikes are going to end. I don't think they're fully going back to work yet, but they're not picketing anymore. And yeah, it's still just one, and it ended up being, the writers' strike ended up being a little bit less impactful than the actors' strike. Obviously, the actors are have a much larger impact on filming than writers did. The writers obviously still had a major impact. But yeah, it's a good stepping stone along the way, and hopefully the SAG-AFTRA, which I'm not going to try and remember what that acronym stands for, but it's the actors union anyway. They're still, their strikes are still ongoing, but hopefully, given that the writers have now agreed to a deal, the actors might be next. It looks like both parties are. I think the writers got most of what they asked for, so it might end up being that the studios are just going to cave and give the actors most of what they wanted as well, which might not be a bad thing. A lot of it revolves around just it's an adjustment to the new structure of the business. With they're not getting the same, they haven't been getting the same residuals from streaming as they used to from like DVD and Blu-ray sales. So it's basically just transitioning to a more of a streaming focused model. Probably going to end up meaning that the prices for streaming products rationalize a bit more over time. So obviously they've been quite a bit lower because they haven't been able to pay, they haven't been needing to pay these sort of residuals to actors and writers and other members of the production team for successful TV shows and so on. So it's now that they are transitioning to a model where they're going to receive these residuals, you can probably expect the pricing to get a bit more rational in terms of how much people are paying for their monthly subscriptions to Netflix or Max or whatever. But yeah, and there's the other little thing that's a potential sort of like tail risk to be concerned about is that the support, the union for the support workers, which are like the cameramen and women, prop team, sound, light, and all that kind of stuff, physical effects and everything. Their contract is due to be renewed next summer, so I think August next year or something. So we've got a potential another sort of tail risk that just as things are starting to get back in and all the disruption from to scheduling and all that kind of stuff, because they've basically got to try and get all these movies that have been pushed back now. They've got, I don't know, 5-6 months worth of films that need to be squeezed in to the existing schedule for next year as well. So yeah, it's quite going to be a big impact anyway. But if we suddenly have another strike from another part of the thing, that's going to be not going to be great. But hopefully that won't happen. But it's just something to be aware of. And moving on to Taylor Maritime Investments, they've announced the Grindrod, which they own, I think about 90% of, is going to acquire the commercial and technical managers of the TMI fleet, which were actually companies previously set up by the management of TMI, Edward Buttery and so on. And that was, TMI was basically, they transferred quite a lot of the fleet that they were managing previously. They sold them, it was all sold to TMI as the sort of the seed portfolio. So yeah, it's sort of a related party transaction. As a result of that, they do still own and I don't think they day-to-day manage the commercial and technical managers anymore, which is actually called Taylor Maritime, I believe, and Tamar. I'm not sure about Tamar, whether they own a stake in that one. But those two companies basically are going to be acquired by Grindrod. And certainly the Taylor Maritime one is going to mean some payment is going to whatever the ownership stake was, going to Edward Buttery, the CEO of both TMI and Grin, and other members of the management that have stakes in it. But yeah, I'll get a little bit into that in a second. But just in terms of what they're paying for them, so the total consideration is approximately what they're estimating it, based on what they think the performance will be, because there's some contingent consideration component. But they're estimating the total consideration is going to be $11.75 million, but up to a maximum of 13.5 if all they met the absolute maximum performance conditions. And this is going to be $2 million in cash up front, with the rest being paid in shares over 2 years, and again, dependent on performance and so on. But yeah, being a related party transaction, I was initially wary, but I reached out to investor relations with my sort of concerns, and it does seem like a logical move commercially. They did go into quite a lot of detail about the justification for it, and I asked specifically as well why, if this was such a good move, if it was necessary for them to actually own them, why hadn't TMI acquired their commercial intelligence managers before they acquired Grindrod? And they said because the TMI is an investment trust, that wouldn't have been possible. That structure doesn't allow them to actually directly carry out any ship management functions. They're just an entirely investment vehicle as an investment trust. And Grindrod, which is a company that is able to do stuff, that has its own sort of subscale management function, fleet management function in place, and so it kind of seems like a natural thing for them to bring in-house the TMI ones and then to actually combine them at the Grindrod level. So it does make commercial sense, and obviously there's the restrictions for doing it at the TMI level, so that's why it has to be done at Grindrod. So yeah, I was certainly mollified by what I heard, and I think I'm happy with the transaction, and hopefully it will realize some synergies when we have one commercial and technical manager managing the combined fleet of both companies. There'll be some savings there, and it increases the scale of the kind of contracts they can get as well. You know, they've got a much bigger fleet. They can start pitching to sort of bigger blue chip companies and things like that. So yeah, it's I think it will work out. And I have to say, like, I haven't seen anything, nothing that's happened, nothing that even though there is some related party stuff going on, which is obviously makes me a little wary with TMI. I've not seen any action thus far in my period of holding them, and I've owned them for a couple of years now. Nothing has been really suspicious. Everything has been perfectly in favor of shareholders. I don't think anything has been. It's hard to say because I haven't really had an opportunity. They don't really make the earnings calls and things like that with analysts that easily available. I've actually reached out, and I should be getting some recordings of them to get a bit more sort of insight. But I haven't really seen that much of management, if you know what I'm saying, like you do with a lot of other companies. So it's hard to sort of get a read from they're just watching them or listening to them, how they respond to certain questions and all that kind of, and how they vocalize things. It's all very well reading stuff, and they do give quite good disclosure of things in writing, but it's easier to make things, you know, look good in writing than it is to create a compelling case vocally. So yeah, I think it'll be good to get a bit more of an insight from that and help to build up a bit more trust. But I do think they have generated good value for shareholders, and everything they've done has been rational and good allocation of capital so far. So I've not had any cause for concern, though obviously you do have to keep a very close eye when you have a company that's doing these kind of related party transactions. But anyway, yeah, just the other thing to mention is that they are refinancing and repaying. They're refinancing all of their debt, and they're repaying a portion of it. So this is for TMI, not for Grindrod. I don't think. I think Grindrod's debt remains in its existing structure. Yeah, they've replaced their revolving credit and acquisition facilities with a new RCF, revolving credit facility, bearing a lower interest margin and maturing in March 2027. As part of this refinancing, they'll make a net loan repayment of around $27 million, bringing the debt outstanding to $167.6 million and the debt to gross asset ratio to around 25%, which is when in the, I think the article of association of the company or whatever, they said 25% was like their structural sort of maximum leverage they were aiming for. Obviously they applied to have that change due to the Grindrod acquisition, but yeah, they'll be paying that down and getting back to what they've originally had in place as the limits set on the company. So yeah, it's good that they've got down to that level, or projecting to get down to that level, and that's using the fleet's valuation as of the 30th of June. It's the latest quarterly update, which was, I think, $1.56 a share, and the shares are trading at about 90 cents right now, so pretty big discount to the NAV there. And they also, in the same note, gave a market update highlighting the approximately 74% increase in average time charter rates since their low in August, which are now sitting at $10,204 per day. This will be for the handy size vessel. And this is still well below the levels seen in 2021 and 2022, positive compared to historical averages. So yeah, they're well positioned to capture the uptrend right now. I think their fleet, the average charter duration is like 3 months or something. They've got a lot of ones that are going to be rolling over, and charters are going to be ending soon, so they'll be able to roll those into the higher rate charters, so sort of just carry them through and capture some of these higher rates, which are coming back up. They're still well below what they've been recently. They in the last year, or the 2022, 2021, it was getting up to sort of $20,000. It was getting really crazy. The rates had a massive spike, so now it's come back down to sort of more. It's still in a pretty good place compared to the historical averages. 10,000 or whatever dollars per day is still quite good for most of the time. Like most of the last decade has been that would have been a pretty good rate. So yeah, it's good to in a pretty good place. But yeah, it's hopefully we'll see a bit of more upside from here, and they can capture it. So moving on to tinyBuild. So there's quite a bit to cover here because we had their interim results, and I've got here like a link to their investor call on with Investor Meet Company. Is on YouTube now, so you can go listen to that back. There's some very good questions in there as well, and I did attend the analyst call as well, and I've got to say the questions from the actual investors that hold the shares rather than just the professional analysts were a lot better. So I was quite impressed with my fellow individual investors, that we definitely asked the better questions compared to the professional, in quotes, analysts, which about half of their questions I felt I could have answered myself. So it's pretty shameful, really. But anyway, let's just have a look through some of the highlights that I sort of picked out. Just to note that the results were certainly down on the prior year, and in some of the headline ones anyway. There are some components that held up pretty well, as we'll see, but yeah, this is what management was guiding for. They were back in the trading update around the time of the AGM, or the day of the AGM, 29th of June. They laid out that their expectations, all these things, that's what initially caused the major drop in the share price back then. But yeah, so a lot of it is to be expected. There wasn't a great deal of new stuff other than just sort of solidifying what their guidance had been into actual real numbers. So yeah, let's just get into some of these. So revenue fell 19% to $23.3 million compared to $28.8 million the prior year. And this is primarily due to a $5.9 million drop in development services revenue. So this is like the platform revenues from like either exclusivity deals or just fees for having them listed on things like Game Pass or PlayStation Plus and so on, or things like Meta's Quest platforms, on things that I haven't title listed on there, or on Google Stadia when that was a thing, all that kind of stuff, these sort of different platforms. But revenue from game and merchandise royalties, which is sort of like the direct-to-consumer stuff, remained pretty well flat year over year. So it was 17.455 million versus 17.466 million the prior year. So pretty much flat year over year. And considering, those different factors, the fact that the actual direct-to-consumer sales held up nicely was a positive. I wasn't necessarily expecting that. And they've said, they're expecting for the full year the development services revenues to remain low, but then they emphasized that it's not zero. They still got some things coming in, like we know that Pigeon Simulator, for instance, is going to be coming out on Xbox, launching to Xbox Game Pass on release, and there's presumably some other titles or revenue they're receiving from renewing things for other titles that are on there and so on. It's not gone to zero, but it has what has been the source of some sort of like added revenue on top of the just underlying sort of growth is disappearing. And but the thing is, as they tried to emphasize as well, is that it kind of, when you've got games that are really successful, especially ones that are console focused, like the Hello Neighbor ones, for instance, they really done a lot better on consoles than elsewhere. To have those kind of games when they get an upfront fee from Xbox or PlayStation, whatever, to have the game listed on there, that kind of caps the upside. So if the game then ended up getting, many, millions of players, those could have all been sales that would have generated more money overall for the company than whatever the upfront payment was from Microsoft or from Sony. So it has, while it takes away some of the certainty in some of these, sort of like the floor maybe in some of these revenues, it also removes the ceiling. So you do have more upside there. So when you've got games like Streets of Rogue 2 coming out next year, for instance, and which is looking, and they did actually mention Alex mentioned that he didn't say very specifically, but I can pretty much guess which game it is because of the wishlist ranking. They've basically broken, I believe Streets of Rogue 2 has broken a record for the company in terms of the most wish lists they've had on an upcoming release. So that's pretty incredible to see. So that could be certainly on PC, on Steam. That's something that we can expect this early access launch do very well. So I was kind of surprised because I thought I wasn't sure what Potioncraft had done before its launch as well. So the fact that it's presumably beaten Potioncraft, which did very well, did about 700,000 sales in early access, and then took it comfortably over 1 million when it did the full version 1.0 release. That's very and then all the other platforms, we still got Switch release coming up and all the rest of it. That really, to me, makes me think we could be looking at comfortably over 1 million sales for Streets of Rogue 2, for instance. So if they took some upfront fee, let's say, and yes, that could still happen on PC anyway, but let's say the Xbox revenues they could have had from it were maybe not 1 million, but or across consoles, maybe it's similar sort of number overall. If those had been locked into some upfront deal just to get them put on Game Pass, that could really have just cannibalized a lot of the upside revenue they potentially could have had there. So the fact that maybe these kind of deals are not going to happen, it might still happen. They might see the potential of a game like that and go, oh, actually, we really want a piece of that, but we'll see. But I'm not necessarily sure whether that would be the right move from what I'm trying to say here. But yeah, so to have that the upside kind of capped over. Anyway, and the other thing about Streets of Rage 2 versus something like Potioncraft is I believe that Streets of Rage 2 were, I believe that Potioncraft was probably a third party IP. We don't know for sure, but I would expect the margins are going to be significantly better on Streets of Rage 2 than Potioncraft. So if we did have similar success or even better success, given the wish list, the prediction from the wish list, and they have said that they're able to very accurately predict what the sales are going to be from the wish list. So on that basis, it could be quite promising. But yeah, on that, looking at it like that, I do think we could stand to make an awful lot more money from Streets of Rogue 2 than it did from Potioncraft, which obviously was an exceptionally selling game at the tail end of last year. Yeah, that said, let's move on. So a revaluation of the company's intangible assets was conducted, and this is where the biggest piece of sort of bad news, I would say, is resulting in the impairment of $18.3 million of capitalized software development expenses, $6.1 million of goodwill, so basically just wiping out all the goodwill, and $2.8 million of other intangibles. So this led to a net loss for the period of $25.283 million. So yeah, we know for like the impairments of the software development expenses, this included some actual like full-on cancellations of some games that were in development, presumably not ones that have been announced, but some earlier stage titles that they decided were not going to be as commercially viable. And they did actually disclose in the note for this that they've now been using like a discount rate of 13% for their projections of to actually determine whether a project is going to be generate sufficient returns for them. So it's that, and like I've said before, they're targeting a 2x return from a project anyway, which would be, if assuming that happens in a shorter, I mean that is over the game's life, but often that happens in a much shorter period of time, and so represents a much higher return than that. But yeah, so not great to see these things, but at least now this is kind of rationalizing things. We're getting down to just, we're cutting the chaff. We're not wasting money on projects that are going to be not going to be so profitable. It's cutting things down to and improving the efficiencies. We're getting cost efficiencies coming in here. So adjusted EBITDA, which excludes impairments but includes the amortization of capitalized software development costs, came in at a loss of $1.249 million. So this reflected the impact of lower revenue, a less favorable revenue mix, with more coming from third-party titles, and a higher amortization of capitalized software development costs, so sort of $5 million versus $3.8 million the prior year. So I would expect some of this came from some of the titles they were releasing this year ended up being sort of flops early on, at least. But the amortization still, so like Firewall Pioneer is an example, but then the amortization still continuing unabated. Doesn't really care what the revenue ends up being on launch. is still going to be amortized at the same rate, the cost. So yeah, I think that's probably what's coming in here with the adjusted EBITDA. So yeah, that's why we're getting that a bit negative, but it is expected to be positive for the overall year. So we'll have to see for that one. But I would say probably somewhat more importantly, from in terms of the company's survivability and yeah, reduce it and just over general sort of cash management. The cash flows from operations held up pretty well despite the drop in revenues, and that they came in at $6.289 million versus $8.811 million the prior year, with $4.175 million attributable to movements in working capital as receivables built up from sales in December were paid in January. So yeah, this was largely I'd imagine things like Potion Craft and stuff like that doing well and making good sales in December, and other titles, obviously, Dead Side, whatever. But then there being a 30-day delay between a sale being made and then the platforms like Steam or Microsoft or whatever, Xbox, PlayStation, then paying the actual cash to tinyBuild, which pushes it into H1, even though the sales were actually made in H2 of 2022. We'll get a little bit on in the future in a later section about what the cash flow from operations are likely to be in the second half, given the guidance from management and so on. But yeah, let's just have a quick look. So cash and cash equivalents at the 30th of June 2023 were $14.338 million, and management has maintained its guidance for cash to be within the range of $10 to $20 million at year end. This net cash position is then expected to be maintained in 2024, as the company is determined to entirely self-finance itself, reducing development expenditure if necessary. And I've said here from this that we can expect them to be free cash flow break even by next year. So if they're looking to maintain that cash level at around about at least to the 10 to 20 million range, they're going to need to make sure their cash flow from operations match their capex next year, which will be sort of a break even free cash flow. So that's certainly, and that was implied, but it also was actually addressed without actually saying they were going to say free cash flow break even. They said, Jazz did actually say in the earnings call that this is what if we said this, we said that, therefore yes, that implication would mean what the question was, which was about free cash flow. Right, and yeah, on the self-financing bit though, that was a really big takeaway for me from the listen to the earnings calls and stuff like that, was that they have absolutely no intention of using their $35 million credit facility for any kind of just operations of the business. It's not going to be a structural component of the business at all. It was set up for that like unmissable M&A opportunity if they had like a incredible opportunity and they just needed the cash for it, and they didn't want to miss out on a chance just because they didn't have sufficient cash or the shares were too depressed to give an equity component to it. That was the reason they set that facility up, and they have absolutely no intention of using it to finance the sort of operations of the business. So it was quite funny after them having said that and made this very clear that they will cut down development expenditure before they resort to using any kind of debt. It was quite funny then to see some of the analysts, when they updated their forecast for the company, to say they were going to be net debt next year and things like that. I was thinking, oh, these guys are really not paying attention at all. And I'm sorry, but their models are not going to be better than management with internal access to all the wish lists, sales data, all that kind of stuff. They're going to have a much better foresight of what they think revenues are going to be and how they think games are going to do, and what they're going to need to do in terms of how much they're spending on individual projects and so on. So yeah, it was pretty silly to see some of those forecasts from some analysts, but it's obviously created opportunities for us. But the other thing, and they showed this in the slide deck, I haven't got it up unfortunately, but they showed that the distribution of, they've got 50 plus projects on the go right now, and this is, I'm guessing, including porting games as well and other things like that. But they showed you just this distribution of how they've, and what single project has got more than sort of 15% of the overall spending on it. But yeah, this big just different sort of size rectangles for the different weights of how much money is going into each project. It was kind of interesting to see that graphic. So you can see that in the earnings call. So I recommend having a look at that I recommend looking at the earnings call anyway. But that graphic was quite good to see. So yeah, talking about expenditure on software development costs, this went up in H1 22 to $16.925 million versus the expenditure in H1 2023 was up on the H1 2022 at $16.925 million, just shy of $17 million, versus $14.245 million in H1 of 2022. But it was down on H2 of 2022, which was $21.544 million. So they are coming down, and they showed also in the slides there a graph of it going up and then coming off the peak, just this every half year, it just increasing until now it sort of seems to be coming down and then leveling off. And they're saying they're just going on this. So the total software development costs for the full year are expected to be similar to those in 2022, implying, so that 2022 was about $35 million, I think, for the full year. So this implies expenditure for H2 to be around $17 to $18 million. And then from this, because we know that cash is it guided to remain within the $10 to $20 million range, this would require operating cash flows for H2 to be at least $13 to $14 million, compared to $10.377 million in H2 of 2022. So this is, we can kind of deduce what they think the cash flow from operations will be in H2. So quite a nice figure, and obviously quite a bit of this is going to come from the cost cutting they've done. So they'll be reducing the ongoing expenditure on the software, on various things, but on the development of these projects they've cancelled and all the rest of it. I'm guessing they're going to be trying to pull down general and administrative costs as well, but just overall looking to make things bring down costs. And then I'm guessing with this as well, we've had a couple of quite successful games released already in H2, Punch Club 2 and I Am Future, and then we're looking probably at, hopefully Broken Roads will be good as well. We might have Level Zero. They've got quite a few other titles for the rest of the year that would still fall within the H2. I believe the cash would still be coming in within H2. Certainly Broken Roads will be November, so it should be coming in before the end of the year. The cash 30 days later and so on. So it's looking like that certainly could be achievable, and that's obviously what they're expecting. So after the asset impairments, total equity attributable to shareholders on the 30th of June 2023 was $86.572 million, compared to at the year end of 2022, it was $111.634 million. So of this total, $42.604 million comes from capitalized software development expenses, which is obviously where a big portion of the write-offs came from, and $21.079 million from purchased IP. I don't think that got any impairment really. And goodwill is now pretty well nil. I think it's like $29,000 or something fairly minuscule. Yeah, so the equity there, it's still, yeah, I don't know, 4 times the market. I don't know what the market cap is right now, but it's been fluctuating all over the place, but probably something like at least 3 or 4 times the market cap right now. So you're getting a pretty massive discount to the in large part things like you're getting a major discount just to the capitalized software development expenses, just the pipeline of upcoming titles and the rest of it, not to mention the earning power of the existing titles that have already been fully amortized, like Graveyard Keeper or what have you. So yeah, it remains, of course, very cheap. Finally, a couple of legal claims have been made against the company in relation to Versus Evil and Red Cerberus. So the Versus Evil one, I believe, was it was in the right at the end here in note 13. So this was basically a one of the parties that tinyBuild had purchased when the prior owners of Versus Evil was claiming that, well, basically wants to have some of that contingent consideration that they think they're obviously owed. And then there was another, the Red Cerberus one was somebody who was providing consulting services to the company, and they're claiming that an employee of Red Cerberus misappropriated the claimant's confidential information while employed by Red Cerberus. But anyway, the sounds probably more minor than the first one anyway. But yeah, they don't believe there's any cause for concern there. They've not, and apparently it's not actually a lawsuit that's been filed. It's a lower level than that, about as low as it can be apparently. So management has made no provision for these claims, as it considers the probability of payment to be remote. So I think that for the moment I can kind of put a line under that. But yeah, we'll see whether that stance changes and whether any provision is required in the future. But that is just the standard part of doing business. Once a company gets to a certain size, these kind of legal claims do happen. Yeah, and I guess you can't fault the prior owners of Versus Evil for trying. It's if you sold a company for a certain price and there's contingent consideration in there, you're going to try and fight for it, aren't you? Even if realistically here, the performance didn't justify it, probably. Right. So yeah, that concludes the update here. Yeah, I recommend having a look at the earnings recording. It's particularly good. Obviously, read through the actual file itself. There was some good stuff in the presentation and the earnings call that wasn't in the filings, and particular kind of stats and stuff, like I was talking about the percentage sort of distribution amongst all the sort of 50 projects and all that kind of stuff. So yeah, definitely worth watching that in as a complement to the sort of official filing. Yeah, and go over and if you want to get these updates in your inbox directly, you can go over and subscribe for free to firmreturns.com. Very easy to do. It would just be up here. You'd have a subscribe button. Yeah, so I'll catch you all in the next update. Thanks for listening.